If there is one person whose thinking has always given incredible insights to others, it is Luis Maizel. He is the founder of LLJ Ventures, a private equity company with a real estate focus, LM Capital, which does institutional fixed income, and LM Advisors, which helps high net worth families in their wealth management. What was your earliest business venture that you did?
My earliest business venture started when I was in my first year at university. I was driving in Mexico City towards the National University of Mexico, where I got my engineering degree, and I saw a sign in a glass factory that's there on the freeway saying that they were selling some plastic bottles. So I was intrigued. I stopped after classes, and they had 42,000 bottles.
Wow.
That had been misprinted. They wrote the name of the shampoo with a 1 T instead of 2 T's, and they were selling them for a fraction of their cost. So I bought them, and then I started to think what to do with them.
Wow.
And I ended up selling them in the gas stations with distilled water. At that time, the car batteries required to keep them wet. They had little caps that you would open up and put water. So I started selling 42,000 bottles of water in gas stations. And that ended up in a company doing additives for gas, for oil, which I sold when I went to Harvard Business School.
Wow. And that's where you got your industrial engineer?
My industrial engineering is from the University of Mexico.
Yeah, okay.
At Harvard, I got an MBA.
Yeah, no, that's incredible. How did you go from industrial engineering to managing investments and things like that?
When I first studied in Mexico, I liked numbers, but I liked business more. So if you were fairly good with numbers, you had several options. One was math, one was accounting, was to be an actuarian, or to be an engineer.
Okay.
And of the four, the one that looked the most appetizing was industrial engineering.
Yeah.
I never thought I would end up being a practicing engineer. I always thought it was a stepping stone towards going into business. At the business school, they have probably, out of the 800 students, there are 300 different undergrad degrees.
Wow, okay.
And I would say that engineering might be about 20% of the class. And in fact, they get a better initial salary, the students that have an engineering background. Okay. Companies believe that the combination of engineering and business makes you more comfortable with numbers and more analytical, which will help you no matter what business you get into.
Oh, that's interesting. And that makes sense. I never really thought of engineering. And see, one thing I admire about you is your ability to make something very simple that's very complex and make it have the same metaphor. One thing you said a while ago, I don't know when you use this, but you said you'd rather be the head of a mouse than the tail of a lion.
Absolutely.
How does that?
When you are the tail of the lion decides where you go, and you follow. When you are the head of the mouse, you're small, but you lead your own way. So I'd much rather be a big fish in a small pond than a little fish in the ocean. I think that you have a better payoff if your ideas work out, and you're taking bigger risks, yes, but if you're confident in yourself, you are willing to take those risks.
Do you like to manage your own investments, or do you invest with other people?
I like to manage my own, Eduardo, but if you want to grow, you have to trust other people. Your time is finite. I mean, you can only do so much. If you find good partners and you can piggyback on their expertise and their dedication to business, your ability to grow is much bigger. You know, how much can you manage yourself? I mean, let me give you a coarse example. Ray Kroc, he could have never managed 50,000 restaurants on his own.
Right.
You know, he managed the first three, which he bought from the McDonald brothers. And the fourth already, he said, I cannot divide my time in four. I don't have enough time in the day to visit 4 different ones. Or he would have had to have them all together to be able to go from one to the other. So the idea is you concentrate on what you do best, on what is your main driver, and if you have excess resources, then you find the adequate partners. It's more important to find the right person than the right business. I mean, a good business with a bad partner or with a bad manager usually will be bad.
Okay.
A bad business with a good manager probably will get better.
Yeah, I've heard people that talk about crowdfunding and investing with people that they need to, one thing is underwriting the business plan, and then another thing is sort of underwriting the sponsor and the people and their track record and if they're good people.
I've never seen anybody lose money with a business plan. Because if it doesn't pencil out, you just change the premises and then it does. I always have said that anybody that owns a PC should be very wealthy because they can come out with any business plan they want. What you just said before, you need to see the track record, you need to see the honesty of the person, you need to see the experience of that person. You are betting on the entrepreneur, on the developer. You are not betting so much on the business. Again, a good business with a bad manager is not a good business.
Okay. That makes sense, even with a good business plan. We spoke a little bit about leverage about a week ago. How do you use leverage in a smart way and sort of protect against possible recessions or downturns?
You need to understand that leverage is OPM, other people's money. And you have to be able to forecast how will you make up if things don't go well. You should not get overextended. You should only use as much leverage as you can manage. If a property pencils out to have 80% debt, go with 70 or 65.
Oh, the cushion. Okay.
Run your numbers for a underperformance of 20% from what your business plan says and see how much can you pay. The amount will depend a lot on the conditions, on the covenants of the loan and the rate you're paying. Sometimes the covenants are the ones that kill you. They might say your revenue has to be 1.5 times interest or 2 times interest. It has different restrictions. If it's just money, you'll say, well, I need to pay $10,000 a month to the bank. The property generates 13, but I have other sources where I could stand for a year or two paying the 10,000 even if the property is empty.
Okay.
So that will allow you to not lose your property in bad times. Again, you should be very careful not to overextend yourself. One of the crises in the real estate industry is that owners tend to take advantage of the good times when the properties are worth more to borrow, refinance, and buy other properties. So in the good times, they grow a lot. In the bad times, the debt they took eats them up. So let's say you own 5 properties. You go, you refinance the 5, or you refinance 4 and you sell 1. And then you have a little kitty set aside for the bad times.
Right.
If you build up that reserve, you're going to be fine. With
see.
the money you got from the 4 you refinance, you can buy a 5th one. But you already have put away in the bank the proceeds of the 5th one, which will allow you to be able to stay alive in bad times.
Okay. With interest rates now being so low, do you think they're going to stay that way for a while?
That's a good question. Interest rates are basically, short-term interest rates are set by the government, the cost of funds, etc., but long-term rates are set by the market. It's very different. I mean, you have an inversion today of the 3-month and the 2-year notes. We had one of the 2 to the 10-year just a couple of months ago. There is not a lot of fear about inflation right now. Inflation is the biggest driver of interest rates.
Okay.
You have negative rates in Europe and Japan on the 10-year government bond. The U.S. is still yielding roughly 135 today, 140, which is the lowest we've seen in a long time. But at the end of the day, the U.S. is not accustomed to negative rates. I think we're pretty close to the bottom of the rate range.
Mm.
On the other side, inflation seems to be under control. The globalization of production is such that a lot of the emerging countries have based their industrial policy on exports. So they're willing to subsidize exports. So there is plenty of product to buy. It doesn't matter how much money there is around. People say if money supply goes up, inflation must come. That's a false statement.
Mm.
If money supply goes up, but supply goes up proportionately, there is no inflation.
Okay.
Let me give you an example. Singapore from 57 to 89, 1957 to 1989, their money supply grew up 700-fold, 70,000%.
Wow.
Their inflation over those 28 years was 82%.
Wow. Okay.
What happened? They had more products to buy, the shelves were full. So it doesn't really relate exactly in terms of how much liquidity there is, because if there's plenty of product to buy, there is no inflation.
Mm.
I think we're going to hold to low interest rates, not as low as we're today. I think the 10-year will hover around 2% for the foreseeable future.
Okay. That's interesting. Well, that's good to hear. I mean, I'd never heard it from that standpoint of view, long-term interest rates also. When it comes to looking at properties and real estate as an investment, do you different investors look at it more from an appreciation standpoint or a cash flow standpoint. Do you have a specific kind, and how come you look at it that way?
I don't believe in the pure appreciation as a thesis to purchase a property. Real estate is very cyclical, so the prices are not something that is written in stone. So I think a property should have life of its own, be a good investment, and for you to be able to sell it if it's convenient to do so, if the cycle works in your favor.
Okay.
But I think the bet on just the appreciation of the value of the property is not sufficient for me to buy a property.
Right. Okay. So when you go for like higher cash flows, are you going to a different type of location? Because from what I've seen, the like A locations, it's just almost impossible to buy them. Maybe it's the time, the last 10 years, but are you sacrificing maybe quality or location for better cash flow, or does that not go hand in hand all the time?
They do go hand in hand, but you have to analyze everything in your life on a risk-adjusted basis.
Okay.
If you are taking less risk because of the quality of the property, you are willing to sacrifice return. But again, it has to have a decent return. If you're going to make, if you're buying a 4 cap today and you're financing it at 4%, it doesn't really make a lot of sense.
Right.
If your cap is not higher than the cost of money, then what's the point of levering a property? It's just taking a risk. So to me, it makes sense when the property returns at least a couple points more than the cost of the money to buy it. So the 30% I put in equity will yield, say, 6% or 5.5%, but the other 70% will yield 2 points.
Right.
So then I'm getting roughly 7% on my own money,
Right.
which is decent enough if the property is high quality.
Okay. How does real estate play a role in the way you want to or structure your own portfolio?
I am very well diversified in my holdings. Real estate is a long-term hold. I expect it to hold value in inflationary times. I would not put all my chips in one basket. For me, you need to have public instruments, stocks and bonds. You need to be in private investments, private equity, venture capital. You need to have real estate, both to hold for a long period of time and maybe to speculate a little bit if you're buying it right. I even have a little cash in my portfolio, and believe it or not, I have some gold that everybody used to say that I was pretty dumb, and it's up 29% in the last year.
Oh, wow. Even at these times?
Gold
Yeah.
hit its highest in 10 years last Friday, and it's up again today on the drop of the market. The market today is down 1,000 points.
Wow. Okay.
It's a response to the virus, and people run to safety, and safety means U.S. Treasuries, means gold. So when one part of your portfolio drops, you want another part of your portfolio to hedge your position.
Mm-hmm. That's interesting. One thing that I kind of wasn't sure about this show, you know, it's called the long-term real estate investor. I don't think, I wasn't sure, but you would sell if you had a profit, or are you a long-term, I guess you are a long-term real estate holder.
I never go into property thinking that it's forever,
Mm-hmm.
and I never go in saying, I'm just going to flip it.
Mm-hmm.
I go in because it makes sense. If they make me an offer at a price that I would not pay for the property, that I think is overpaid, I consider very seriously selling it. If they're paying me fair price at which I would either buy or sell, I would not sell.
Okay. What are the biggest mistakes people make in managing their own money that you've seen, or that people can avoid if they had a little bit more experience and knowledge?
First is the Me Too attitude. You know,
Okay.
you hear from somebody that they purchased such and such stock, so they want to go and buy it, and probably that person bought it some time ago at a lower price, and the appreciation has already happened.
Okay.
The second one is when you follow the advice of your friends and family. They joke that in Vegas you have two kinds of people that go to Las Vegas, losers and liars. You always hear that everybody comes back and says they made a fortune.
Yeah.
Maybe 1 in 100 comes back with a fortune, and 30 lost a fortune, and the other 69 came out okay.
Mm-hmm.
So you should have a plan. Each segment of your investments has a purpose. It acts on its own, but it interacts with the rest of your portfolio. You need to have public instruments, you need to have private instruments, you need to have inflation hedges. So, I mean, today, the yields you're getting, the rents you're getting, you know that your portfolio is growing very slowly.
Right.
So you need to have other things that might give you better returns, maybe not as liquid. In times of big inflation, you have to stay in things that are adjusted to inflation. You know that public instruments are going to suffer, so you lower your position. It's a dynamic allocation.
Okay.
The problem with private investors are that they don't understand when to rebalance. They read somewhere that you should have
Right.
X amount in bonds, X in stocks, X in real estate. They do it, but you have to rebalance based on your age, on your expectations, on your family, and on what's happening in the environment.
Okay. That makes sense. One thing that I think a lot of people sort of struggle with is how to approach investing. They might be a dentist or not in the investment world, but they want to put their money in. They want to diversify, but they might not know how much to put in real estate, or if they should invest with somebody or buy their own
Sit down
assets.
with an expert that's just fee-based. You don't want to leave the coop in charge of the fox. If you go to somebody that's going to
I'll
sell
remember
you,
that one too.
if you are going to go to see somebody that will sell you things, you know that that person will sell you what makes them the most. So
Yeah.
separate the advice from the product. Sit down with somebody that has done it many, many times, that has gone through cycles, that has the expertise to help you do your asset allocation, and then go to the experts to execute the plan.
Mm-hmm.
The person with whom you do the plan should not be the same one that sells you the products or the investments for the plan. And even if you have a friend, your best friend, your same age, your same schooling, he might be married, you are not, he might have kids, you don't, or you do. Each one has a different capacity to generate resources and different needs. You might have somebody that has kids that are self-sufficient and others that don't, and you have to take care of them. So for each one of us, there's a different plan. And that plan, you start with the blueprint of your plan, and then you adjust it as the conditions change, either personal or in the business world.
That's great advice, because there really is different. There's not everybody fits in the same
No.
in the same box. Do you have 3 key daily habits that help you succeed and that drive your business?
Yeah, especially as you get a little bit older, you should have a very, very well-defined routine, so you don't miss doing things that you should be doing. Every morning, the first thing I do is I check I wake up before the markets open. I check out the futures and what happened abroad. The second thing I do when I get to the office is I've developed internally a program that tells us anything that moved more than 1.5% either way.
Okay.
So we manage over 650 portfolios for clients.
Wow.
It's very hard to check each one of them every day. But if you check the exceptions, you're checking every one of them, anything that jumps up. And the third one, and probably the most important, keep your life balanced. Don't concentrate in just one aspect of your life. You need to balance family, business, entertainment, your health. If you don't, you're going to pay for it.
Yeah. Well, okay. I appreciate you coming on the podcast.
It was a pleasure, Eduardo.
Thank you. Come meet us over at signetinvestments.com. There you'll have access to our full podcast and articles archives. Also, if you subscribe there, you'll get new updates sent straight to your inbox. You can also find us across all social media platforms. Our handle is Signet Investing. Thank you, and invest wisely.